sheets, the gradual rollout of public spending on defense and infrastructure, and the supportive effects of our past interest rate cuts are underpinning growth. At the same time, the outlook is still uncertain, owing particularly to ongoing global trade policy uncertainty and geopolitical tensions. We are determined to ensure that inflation stabilizes at our 2% target in the medium term. We will follow a data-dependent and meeting-by-meeting approach to determining the appropriate monetary policy stance. In particular, our interest rate decisions will be based on our assessment of the inflation outlook and the risks surrounding it, in light of the incoming economic and financial data, as well as the dynamics of underlying inflation and the strength of monetary policy transmission. We are not pre-committing to a particular rate path. The decisions taken today are set out in a press release available on our website. And I will now outline in more detail how we see the economy and inflation developing, and will then explain our assessment of financial and monetary conditions. So looking at the economic activity first. The economy grew by 0.3% in the fourth quarter of 2025, according to Eurostat's preliminary flash estimate. Growth has mainly been driven by services, notably in the information and communication sector. Manufacturing has been resilient despite the headwinds from global trade and geopolitical uncertainty. Momentum in construction is picking up, also supported by public investment. The labour market continues to support incomes, even though demand for labour has cooled further. Unemployment stood at 6.2% in December, after 6.3% in November. Growing labour incomes, together with a lower household saving rate, should bolster private consumption. Government spending on defence and infrastructure should also contribute to domestic demand. Business investment should strengthen further, and surveys indicate that firms are increasingly investing in new digital technologies. At the same time, the external environment remains challenging, owing to higher tariffs and a stronger euro over the past year. The Governing Council stresses the urgent need to strengthen the euro area and its economy in the present geopolitical context. Governments should prioritize sustainable public finances, strategic investment, and growth-enhancing structural reforms. Unlocking the full potential of the single market remains crucial. It is also vital to foster greater capital market integration by completing the Savings and Investments Union and the Banking Union to an ambitious timetable, and to rapidly adopt the regulation on the establishment of the digital euro. Looking now at inflation. Inflation declined to 1.7% in January, from 2% in December and 2.1% in November. Energy inflation dropped to minus 4.1% after minus 1.9% in December and 0.5% in November. While food price inflation increased to 2.7% from 2.5% in December and 2.4% in November. Inflation excluding energy and food eased to 2.2% after 2.3% in December and 2.4% in November. Goods inflation edged up to 0.4%, whereas services inflation declined to 3.2% from 3.4% in December and 3.5% in November. Indicators of underlying inflation have changed little over recent months and remain consistent with our 2% medium-term target. Negotiated wage growth and forward-looking indicators, such as the ECB's wage tracker and surveys on wage expectations, point to a continued moderation in labour costs. However, the contribution to overall wage growth from payment over and above the negotiated wage component remains uncertain. Most measures of longer-term inflation expectations continue to stand at around 2%, supporting the stabilization of inflation around our target. On the risk, the euro area continues to face a volatile global policy environment. A renewed increase in uncertainty could weigh on demand. A deterioration in global financial market sentiment could also dampen demand. Further frictions in international trade could disrupt supply chains, reduce exports, and weaken consumption and investment. Geopolitical tensions, in particular, Russia's unjustified war against Ukraine, remain a major source of uncertainty. By contrast, planned defense and infrastructure spending, together with the adoption of productivity-enhancing reforms and the adoption of new technologies by euro area firms, may drive up growth by more than expected, including through positive effects on business and consumer confidence. New trade agreements and a deeper integration of our European single market could also boost growth beyond current expectations. The outlook for inflation continues to be more uncertain than usual on account of the volatile global policy environment. So inflation could turn out to be lower if tariffs reduce demand for euro area exports by more than expected, and if countries with overcapacity increase further their exports to the euro area. Moreover, a stronger euro could bring inflation down beyond current expectations. More volatile and risk-averse financial markets could weigh on demand and thereby also lower inflation. By contrast, inflation could turn out to be higher if there were a persistent upward shift in energy prices, or if more fragmented global supply chains pushed up import prices, curtailed the supply of critical raw materials, and added to capacity constraints in the euro area economy. If wage growth moderated more slowly, services inflation might come down later than expected. The planned boost in defense and infrastructure spending could also cause inflation to pick up over the medium term. And extreme weather events and the unfolding climate and nature crisis more broadly could drive up food prices by more than expected. So looking at financial and monetary conditions, market rates have come down since our last meeting, while global trade and geopolitical tensions temporarily increased financial market volatility. Bank lending rates for firms ticked up to 3.6% in December from 3.5% in November, as did the cost of issuing market-based debt. The average interest rate on new mortgages, again, held steady at 3.3% in December. Bank lending to firms grew by 3% on a yearly basis in December, after 3.1% in November and 2.9% in October. The issuance of corporate bonds rose by 3.4% in December. According to our latest bank lending survey for euro area firms, demand for credit was up slightly in the fourth quarter, especially to finance inventories and working capital. At the same time, credit standards for business loans tightened again. Mortgage lending grew by 3% after 2.9% in November and 2.8% in October, in response to still rising demand for loans and an easing of credit standards. So to conclude, the Governing Council today decided to keep the three key ECB interest rates unchanged. We are determined to ensure that inflation stabilizes at our 2% target in the medium term. We will follow a data-dependent and meeting-by-meeting approach to determining the appropriate monetary policy stance. Our interest rate decisions will be based on our assessment of the inflation outlook and the risks surrounding it, in light of the incoming economic and financial data, as well as the dynamics of underlying inflation and the strength of monetary policy transmission. We are not pre-committing to a particular rate path. And in any case, we stand ready to adjust all of our instruments within our mandate to ensure that inflation stabilizes sustainably at our medium-term target and to preserve the smooth functioning of monetary policy transmission. And we are now ready to take your questions.
First question goes to Alex Weber of Bloomberg. Alex, please.
Thank you very much. Good afternoon. My first question is on the risk assessment. Given the events of recent weeks, including new tariff threats by the US, would you say that inflation and economic risks on both sides have become more pronounced again, and has the ECB's good place perhaps become a little less comfortable? And then I'm also curious how you discussed the euro's exchange rate this week during your meeting.